Are we about to see the end of the dollar standard? Well, in this video we take a look to investigate this and look at the potential outcomes and what it means for gold and also Bitcoin. So let's dive on in. Now, going back to the Wall Street crash in 1929, in the run-up to this collapse, the US was accumulating gold reserves, and under the gold standard set at $20 per ounce, this meant there was growing demand for the US dollar. A key reason for this was due to the Dawes Plan, which involved the US providing substantial loans to Germany to help restructure and rebuild their economy. In turn, Germans had to pay reparations to Britain and France, who in turn had to repay war debt to the US, as we can see here. At the same time, the British economy was in a period of deflation due to large war debts and failing to revalue the pound appropriately after abandoning the gold standard to finance World War I. The British couldn't cut interest rates for fear that more gold would flow towards the US, so the Federal Reserve cut interest rates to try to avert a run on the pound. The US stock market boomed, but after the Wall Street crash, as the US economy became weaker, the dollar actually got stronger and stronger, peaking in 1933. Meanwhile, Britain had to devalue in 1929 and again in 1930. And as for the Dawes debt, well, only around 10% was actually ever repaid. Meanwhile, the US economy endured the worst of the economic crisis as a result of its excessively strong dollar and substantial domestic debt. Ultimately, the US was forced to devalue its currency versus gold. There followed an enormous expansionary fiscal policy response, and famously today, Jim Rickards has written of how this can be used to actually reinflate our economies given the current ongoing crisis. Right now, there is a silent currency crisis taking place all around us, whether we're aware or unaware of it. It's the consequence of the decades with which the US has been the global reserve currency for the world, which has led to an enormous demand for offshore US dollars. These unsecured US dollar deposits held outside the US are referred to as Eurodollars and have nothing whatsoever to do with euros. Just consider a Mexican firm invoicing a Brazilian firm. What currency will they choose to invoice in? Well, it's going to be US dollars. While initially such power seems positive, the burden can take a heavy toll over time. Now, after World War II, the Eurodollar system began to emerge as the US began to consume more from the rest of the world. This gave rise to an increasing amount of dollars being held overseas. But there were growing concerns that the US could weaponize the dollar during the Cold War by freezing communist countries' dollar-based bank accounts held with offshore US banks. This prompted the USSR to make its first dollar deposit to a UK bank in London in 1957. Today, the Eurodollar market is huge. In this table from an excellent article in Zero Hedge, we can see that prior to the crisis, the market was $57 trillion, nearly 3 times the size of the US economy. The link is in the description. But this highlights the enormous demand for US dollars, whether it is for imports, bonds, loans, credit guarantees, or even derivatives. The fractional reserve banking system means that Eurodollar deposits can be multiplied many times over. Yet only the US, of course, has the actual ability to create new US dollar currency. Ultimately, what the Eurodollar system implies is that global financial markets and the global economy rely on the US dollar for pricing, accounting, and trading. A system of hundreds of different currencies, or even a dozen, would be so difficult to manage. And crucially, it would not allow anywhere near as much cohesion and integration within our globalized economy. Thus, the world is beholden to US monetary policy cycles rather than local ones. Higher US interest rates or a higher dollar are really ruinous for countries that have few direct economic or financial links with the US. This is why we've seen such an effort by Russia and others to move away from any reliance on US dollars. Yet this is also requiring the Fed to act increasingly as the world's central bank. Now, in 1959, economist Robert Robert Triffin identified a key dilemma, which was that the US, in issuing reserve currency, would have to balance its domestic policy with its international responsibilities in benefiting other countries. Consequently, being the reserve currency provider is a threat to national sovereignty. The structural change and deindustrialization that the US has actually endured through being the global reserve currency provider has been a painful burden and has led to an inevitable increase of nationalist sentiment. It causes significant long-term damage. A further problem is that the flow of US dollars from the US to the rest of the world must be large enough to facilitate global demand and the needed liquidity for dollar-based transactions. But the US represents a smaller percentage of overall GDP, overall global GDP each year. Nevertheless, it must keep Eurodollars flowing outside of the US system. This is why we see the US running such large and persistent current account deficits, because of its excessively strong currency. But what we've seen so clearly in recent weeks through availability of medical supplies is that the supply chain needs of strategically important industries have been severely compromised. Consequently, without military supremacy, the US cannot long maintain its multi-dimensional global power. Thus, the US may well increase its protectionist policies, but this will limit the availability of dollars overseas. This is a problem that's further exacerbated by the fact that foreign oil producing countries are now receiving less demand and less dollars for their oil, thereby reinforcing dollar strength. Over the long term, economist Robert Triffin believed that there were only three ways that the dilemma could be resolved. First, by the US walking away from the burden of being the global reserve currency, or others losing faith in its persistent current account deficits. Secondly, that the US would need to take over the global financial system, or third, that the global financial system fragments, and while the US may retain control over certain parts of it, other countries will be left to make their own arrangements. In a future video, we'll have a look at exactly what Russia and China are pursuing in the event that there is complete fragmentation of the US dollar-based system. Now, fundamentally, the Eurodollar system is always short US dollars, and any loss of confidence sees everyone scramble to access dollars at once. Effectively, this causes an invisible international bank run. The dollar's rise is likely to lead to substantial debt defaults, which further reduces dollar supply through write-offs, just as occurred in the 1930s. And it's on this basis that Brent Johnson actually founded his dollar milkshake theory. But the Eurodollar market only really works when there is a constant case of rolling over of US debt. But the smashing of confidence and economic activity has led to enormous volatility in currency markets. Just check out the Mexican peso, the Aussie dollar, as a few examples. Moreover, this has led to dramatic variations between the Fed funds rate and the LIBOR rate of interest. That is the onshore versus the offshore dollar interest rates. Thus, the IMF are seeing a large number of countries seeking IMF dollar-based loans. Now, the Fed's newly introduced FEMA repo facility is meant to reduce the demand by creating a swap line, allowing foreign central banks to swap their holdings of US treasuries for US dollars. This allows friendly countries with less reputable currencies to access dollars without requiring the Fed to increase holdings of, for instance, Brazilian real. But this only works in the short run, as when the swap is reversed in the future, it drains Eurodollar reserves. And Eurodollar expert Jeff Snyder on Rebel Capitalist podcast stated that the Fed's intervention here will do more harm than good. So far, the Fed's interactions have failed to calm the TED spread, which measures the difference between US Treasury bill rates and the interbank lending rate, the LIBOR rate. This illustrates a tightening of credit and a growing lack of trust between financial intermediaries, as we can see here, and this spiked badly back in 2008. This credit tightening and excessive dollar demand means that it's going to require the Fed to take ever greater intervention, and this would mean the availability of Eurodollars on an enormous scale. The alternative is that we see an increased fragmentation of the global financial system and a partial collapse of the Eurodollar system, and this is what Russia and China are already preparing for. Now, historically, the Fed has been happy to intervene to ease Eurodollar strains, yet the scale that is now needed is entirely unprecedented. What's more is that it isn't just central banks or banks, but foreign corporations who represent an enormous $13 trillion of dollar-denominated debt, an amount similar to that of the Dawes debt in the Great Depression. Furthermore, many of these firms will be in direct competition with US producers. This is where the US dollar can be weaponized and all sorts of potential strings can be attached. But what is truly different now is that many countries are aware of the dangers that the Eurodollar actually presents. While China has enormous demand for dollars, would they really want an influx of Eurodollar liquidity which reinforces their reliance upon the US? I'm not so sure. So where are the Eurodollar pressures the greatest? Well, World Bank data suggests the largest demand supply mismatches exist in China, the UK, Japan, Hong Kong, Cayman Isles, Singapore, Canada, South Korea, Germany and France, with total short-term demand amounting to $28 trillion, 130% of US GDP. Meanwhile, consumption in the US is falling, and this means less dollars are actually being exported right when they are most in demand. So this would suggest that we are going to start seeing the Fed taking ever greater power over the global financial system. But this will require even bigger increases to the Fed's balance sheet. Moreover, the sheer scale of the fiscal stimulus being considered means that a deficit of 20 to 25% appears feasible. And while bond yields in the US right now remain low, and those who can access newly created Eurodollars will eagerly take them up, there is a question which remains unanswered, and that is that how far can those 3 Ds, the debasement, the deficits and the debt, go before the dollar collapses? Could history be repeating itself once again, and we see a devaluation of the dollar and the consequent need of the Fed and its massive balance sheet to revalue gold to reinflate the economic system? It remains one possibility for sure, although to the Fed it really is the nuclear option. They will want to retain control. Control P remains the easiest approach right now. Meanwhile, Raoul Pal believes that the end of a dollar standard could actually see Bitcoin going to $1 million. We live in extraordinary times. Thanks so much for watching, and I look forward to seeing you next time. Don't forget to subscribe, hit the like button. I'll see you then. Bye bye.